It's still the early days of the new U.S. administration, but we've already had a flurry of policy initiatives, including executive orders and numerous tariff announcements, and that's been raising questions about the outlook for markets and the economy. TD Economics has come out with its latest report, and it's called Questions. We have answers, addressing the issues impacting the economic and financial outlook. And boy, oh boy, do I have questions. Joining us now is Beata Karentzi, Chief Economist at TD, to run through this. Thanks for putting this out first off, and thank you for coming in.
Thank you for having me.
Okay, you have 10 questions here, and we're going to spend the next 22 odd minutes going through all these in some detail. And I'm going to say I'm going to be tilting a bit towards Canada as you go through this, but let's start with just the really big picture, and then we'll get into some great detail on Canada. You've got some really good information here. How has, for question one, the global economic outlook changed in light of the recent tariff developments? And I have to say also, too, when I say recent, I mean recent is moment by moment.
Yeah, so I think, everything that we're seeing on the global economic landscape with tariff escalation is leading to a markdown in the forecast. The one good aspect is that many economies, Canada included, were ending last year on a better note than the prior year. So there was a little bit of a tailwind coming into various economies in Europe and elsewhere. So we're marking down the economic growth from a better watermark than would have been the case had this been a year ago. But ultimately, we took about 20 basis points off the forecast. We had to make assumptions.
And we say that this is the global forecast.
The global forecast, yeah, it's worse for Canada.
Yeah.
We had to make assumptions that, we don't know particulars yet, but we did assume in our forecast that Europe was going to come into scope on tariffs in a much more active way than we've heard so far. China would remain in scope. They have 10% tariffs. That's likely to rise over time. And obviously Canada and Mexico are already in scope. So we didn't go full board on the assumptions with the full 25% tariffs, on Canada and Mexico on all products. We assumed with time and iteration on negotiations that the Trump administration would likely move towards more product and industry-specific and country-specific initiatives in order to mitigate the cost to the U.S. in terms of inflationary pressures. So we had to embed that assumption. We hope we're not wrong. Mm-hmm. Otherwise, the forecast would be more detrimentally impacted.
And I guess, when I look through the assumptions, which you just told us a little bit about them too, what was interesting is the tariffs are assumed to remain in play for the remainder of this year before being largely phased out by mid-2026.
That's the hope.
But what I'd say is, your job is simply always, making assumptions and going through different scenarios. Yeah. Just why that? Because I know you also say in here you're expecting some retaliation. Yeah. You're also expecting governments, of course, to lean in and spend to try and prop things up. But why is the 2026 just because you hope that at some point? Yeah.
Yeah. Well, there's a few things happening in the U.S. They have their own midterm elections coming in at the end of next year. And so it's going to be important for them to not transmit price impacts to consumers. That's where we've seen in history the population is less forgiving. And so doing things like taking pressure off your prices, which is actually an executive order under President Trump to make the cost of living more affordable, seems to be that there is a little bit of we guess there's a bit of a clock running down on how much time they could run through these tariffs. Also, we're hoping that negotiations take place and that deals are cut between now and then. And when we look at the last Trump administration, it was about a year from when you saw tariffs come in place in the case of, say, Canada in particular, and the USMCA negotiations to when that got finalized. So we're running through about a year-long process where we're allowing this, the negotiations and the price effects to play through, and then hopefully some grounding back to normality.
Another piece you have in here, I feel weird reading back your own report back to you, but it's, you do hear talk about this being on a time-lapse basis when you're looking at the tariffs, and you say that, if full tariffs will remain in effect for 6 months, 1 year, and 2 years, you chose 6 years as the initial starting point, but you go on to say that, you could see the Canadian economy tip into a recession should the tariffs last too long, and unemployment rate peaking at 7.7% by the end of the year.
So that's scenario analysis that we did. So what I described previously was our base case forecast. Right. And then we said, what if we're wrong here? Because there's so many moving parts, and this is a different administration than Trump 1.0.
Yep.
And so we thought, what if the 25% tariffs on Canada and Mexico across all industries hold for 6 months? what does economic growth look like, and then at a year and at 2 years. And the economy in Canada does tip into recession around the 5 to 6 month mark if you're holding at that breadth and scale. Not if you're holding at a lower level, like we said, where they start to get industry specific, like the steel and aluminum tariffs that were announced. So that would be almost now you're moving into your worst case scenario of having longevity and breadth on tariffs. And so that's what we did in that section, just to give people a glimpse of what could transpire. At the same time, inflation metrics move up quite substantially. The U.S. ends up worse off on the inflation front because they're starting from a higher point on inflation already. And so it's our hope that when you look at how administrations are looking at this, they
will feel the pain on that side.
Yeah, who wants to impart 4% inflation over to their population? When literally in the U.S. they're really price sensitive, complaining right now about the price of a carton of eggs, which is $7 in the U.S. in places like New York. So imagine if that spreads broadly to all products.
I want to talk just quickly before we go to break about central banker reaction. Sorry, and the question is, I have to do verbatim, how would central bankers react to trade war scenarios? And I'm going to maybe focus more on the Bank of Canada. What would you expect?
Yeah, so the Bank of Canada has put out quite a bit of information on this, basically non-committal. They're not saying they would cut rates or raise or leave, because they're saying we have to see how the transmission flows through the duality of higher prices versus weaker economic growth. We're betting that they would take a risk management approach to this, saying that it's more likely you're going to move towards deep economic contraction as time goes on, and that overplays any temporary price effect from that one-time level shift in tariffs feeding through to consumer prices. Having said that, we know from the pandemic that people internalize prices very differently than how an economist would think about it. Oh, it's a one-time level price, right? But at the end of the day, someone's saying, well, I'm paying $8 a carton for milk, right? So they're not happy about it.
So I'm not buying anything else.
Exactly. And then those inflation expectations become entrenched. They stay higher for longer, even as prices come down. And that's the effect we saw in the pandemic, where you saw wage negotiations, that process continue on for 2 to 3 years once you're even past that peak point on inflation. So that is the concern the Bank of Canada would have. So we don't expect that even if we move towards a recession. I think people think that they would be, cutting rates aggressively. We don't think they would. They would still remain cautious. Our base case is they can get to about 2.25 on the policy rate. In the event that we move towards a recession, we might see something about 1.5% on the policy rate, but nothing like we saw in the past where they moved towards zero, because they would want to really, interest rates are a single tool. They would be counting on the government to do more of the heavy lifting.
Next question, Beata, with regards to what's happening with the U.S. administration in Canada. How have markets reacted so far to tariff threats? And I want to focus here, if we could, more on currencies and the loonie. What have you seen? What can we get to?
Yeah, so what we saw when that blanket 25% tariff was going to come into effect, it was February 4th, I think it was, and it announced over the weekend on a Saturday. On that Monday, one day ahead of it going live, we saw the currency slipped down to about 67 cents. Now, that trading was reversed because by 10 a.m., Mexico's president had already received word that their side of the tariffs were going to be delayed, which led everybody to believe the same was eventually going to happen on the Canadian side. I think if you had let the market run through with ongoing tariffs and that we didn't get that delayed 30 days, it would not have surprised me to see a 65-cent loonie. And then some people are arguing possibly more to get down to offset that 25% price premium now that's occurring on the tariffs. So it's not a good news story. The loonie would have to weaken. It is a natural dynamic, so you could regain some competitiveness through that side of the price transfer side between the countries. As it stands now, because the threat is not yet quite live, we saw the loonie immediately bounce back, head back towards 70 cents, which tells you where markets feel comfortable. They're still discounting it for uncertainty. Otherwise, it would have been probably somewhere between 72 and 75 cents. So we still think there's a discount being placed. But it gives you a really good sense of how markets are thinking. If we go live with the 25% tariffs, we're going to be right back at a minimum to 67 cents.
Yeah. Okay. Let's move on to I think this is one of the most important questions you have in here. We're going to skip question 4, 5, and 6. It's a great report. You can find a copy and get those ones yourself. We're going number 7. How is Canada's economy performing in the face of elevated uncertainty. And I think this is the biggie.
Yeah, this is interesting because this goes back to the point that had we not had this risk, we would have done a substantial upgrade to the Canadian outlook, because the second half of last year ended quite strongly with consumer spending, well over 3%. So consumers were back in the mood of spending, interest rates were coming down, the housing market was rebounding, really responsiveness to what was happening in the economy. The job market was recovering, doing much better. Unemployment rate was starting to fall. It's down about 30 basis points from its peak. And then January came along and we saw the housing market stumble, and February. And so we're starting to get a sense that there is a confidence channel being impacted here, that even though people maintain their jobs and the risk is not yet filtering directly.
But on the investment side,
the decisions are being delayed. And even some surveys are out there demonstrating that, about 70% of companies are, that were surveyed are saying they're hitting the pause button on investment right now to get a sense of which way this is going to go. And a number of companies assessing that, if tariffs were to come in at 25%, do they need to move operations? And about 50% said they would have to think about that movement of investment over to the U.S. So these are quite large numbers that we're talking about, which is unfortunate because the economy itself was probably going to have a very good year at over 2% growth, and we're going to have some kind of one handle on it now.
Yeah, at least it started off in a stronger place to start with. I'm just going to start with that.
Yeah.
I want to bring up this chart because again, as someone who grew up in New Brunswick, I did a double take on this one, but your team put this together, and the question is, how are different provinces exposed to tariff risks? This is question 8. There's the question, and we'll bring up the chart. Alberta and New Brunswick, 1/3 of exports, 1/3 of their nominal GDP are exports to the U.S.
Yeah, to U.S. exports. So Alberta's resources, obviously, and there's an element of that in New Brunswick as well. And you also see Saskatchewan on there. So anything that's resource-oriented is going to have more appeal on the export market to the U.S. and have more of its economy tilted to that. And then, of course, Ontario makes the list off of the manufacturing side and the auto sector in particular.
Well, let's bring that one up because actually I think we have, the sort of the job picture, sort of, same conversation, different slice. They can look at that. Yeah, you can see that just the number of jobs tied to the auto sector.
Yeah.
I mean, again, this is not new news to anybody, I'm sure, who's been paying attention, but it certainly quantifies it a bit.
Yeah, it quantifies it, and it also tells you that it would be very difficult for governments to backstop all of this, meaning that if we are going to go through an industrial rotation, as Canadian companies oriented to the U.S. shift to the U.S. and vice versa, new companies appear in Canada that service the Canadian market that are being displaced from the U.S. side. This is not, these numbers are too large for federal and provincial governments to backstop wages on a medium or long-term basis, meaning when we were talking earlier about what happens if this goes on for 6 months or a year, just with, if our exports were to drop by 1/3 to the U.S. and you look at the job displacements, that could be over 600,000 jobs. That would cost us about $2.5 billion a day just in wage subsidies a month to support that. So there's not unlimited resources here. And so we would have to think through more creatively what we envision for the country as we go forward, because these are fairly large numbers.
And just in that last point in the report, you point out, the amount that we're selling to the States, but then you actually say down here, and I think it's material, that, they talk about, imports from the U.S. equate to 23% and 11% of GDP in Manitoba and Saskatchewan, meaning that, if they don't have the export impact, they're also going to be impacted by the imports that they can't get, or they have to pay more for it again at the same time.
And there's where the cheap dollar starts to come in all of a sudden, because you're bringing in, you're importing the inflation dynamic to make it harder. And then if you're adding on top of that retaliatory tariffs, you're bringing in the additional prices there. So you can see why this suddenly becomes quite inflationary and not palatable to sustain on a long-term basis, which is also what we're banking on in the U.S. So the U.S. doesn't have the same export exposure as Canada, but the majority of states do see Canada as their primary export market, so it is material at the state level, and that's why you hear a bit more conversation by governors at states saying, we've got to be a little bit more thoughtful about this.
How could the government pivot policy to provide insulation to Canada? And you just finished telling me that they can't backstop everything.
No.
So what do you see?
Well, they have to break it out into like what is the short-term supports you can provide to businesses and households, and by short-term you can be talking a matter of months. And then what is your long-term vision for where you need to take the country as a whole in terms of competitiveness and this rotation that's going to be required. On short-term issues, if you look at what was done in the past, like the pandemic gives you a little bit of reference of policies that are ready to go, but they do have to be legislated, like things like wage subsidies, and we don't currently have a federal government sitting, so you can't just pull that one out of the gate. But we have EI, and you could do, without any new legislation, job sharing tactics where you increase the amount of hours that are permissible under job sharing, which was done during the steel and aluminum tariffs under Trump 1.0, where they went from like you can job share from 36 hours to 76 hours, right? So you can try to prevent layoffs and give companies a bit more flexibility in how they're using their existing labor force. So those are things right out of the gate, not going to cost you any more money, it's already in there. And then you would have to think through, are you going to do wage subsidies? Or is it actually better at this stage to think through how to incent businesses to invest and keep the money in the country? One thing when you're thinking through supporting through incomes, people may choose to take that income and buy products that you're actually buying from the US, and now you've literally just subsidized a purchase over to the US.
Interesting, yeah.
And so you've lost the domestic multiplier inside the country. So one of the recommendations we hear more and more about is thinking through what does that domestic multiplier look like with every dollar coming out of government coffers? Does it stay in the country? Could you put in investment incentives for all businesses? Because you have one segment of the economy suffering who may not take advantage of it at all, but you have a large portion that could, and provide an offset and help get those engines going, especially knowing that a lot of companies are delaying investment right now, and can you incent some of that? And so that's like your near term, like you could be doing tax holidays, GST holidays for inputs and other factors. And then the vision, and this is where people get into making sure we have no interprovincial barriers that are inhibiting investment and growth in Canada. Ensuring our productivity is at the maximum it could be, so looking at income and corporate tax structures. And a big one that is really not going to come in immediate but over stages is thinking about delayering of regulation. And there have been studies that show that if you look at regulation growth, the layering, every year you have more and more regulation come up on top of industries.
It's suffocating.
It is, and it grows at about 2% a year, and it's estimated by StatsCan and I think KPMG that it has reduced investment by 10% lower than it otherwise would be, and it also reduces business entry, new business formation or business dynamism. So there's a lot of work to be done there, but as you know, like that's not going to happen on day 2 or day 50. That's something that you have to be really committed to continuing on over the course of years to delayering that regulation. So that's the vision portion of what governments can do, and it's probably the most important area because people are going to end up suffering no matter what, but you hope that in doing so they have something positive to come out to from an economy that's more dynamic and showing faster growth.
Fascinating. I've only got about a minute and a half here, Beata, so I want to ask you about Canadian housing. So the last one is, what range of outcomes can we reasonably expect for the Canadian housing market this year?
Yeah, so we were optimistic up until December 30th, or January 20th, I guess. And like I said, that data for end of December and into January definitely show that there's a sentiment factor coming through. We don't know 100%. If it was just a lull, but it looks like that in January in particular, home sales were actually doing okay until that final week of January when that 25% tariff threat became quite real to people. And then in February, unfortunately, we had some bad weather in Ontario, Quebec, and across the East Coast, so there's going to be weak sales in there. So we're going to get a little bit of confusion on the signals, but overall, we originally thought that sales could grow double-digit this year from the lower interest rates, but now we've cut that back. We had 16% growth in sales, and we're thinking maybe we get 5% growth in sales. This is a big revision, and that's largely because of that weak handoff that's coming in off of those December and January sales. And the same for prices. We thought that price growth could be somewhere around 5 to 7%, and that looks less likely if your sales are going to weaken, so we might have more of a flat market to maybe 3% growth. So it's going to require those entering the market to have steely nerves to get in and understand that
And understand their time frames.
That's
People
right.
who are buying.
That's
so,
right,
yeah.
and have a sense of job security, because it'll be much more difficult for people on the trade side.